Okay, my name is Bobby Vaught. Two reasons that we could be headed for a market correction at some point in the future. We don't know when. It's not a prediction. I'm using the word could here, but there's two reasons why. Two indicators here we're going to talk about. One is the valuation. The historic average of the PE average of the S&P 500 is about 20.1 or 20.3, something like that. Let's call it 20 PE. Right now, the stock market is overvalued based on that historic average. The S&P 500, right now the PE of the S&P 500 is about 27.5, 27.45, something like that. So based on that, roughly about 35% or so above the historic average. Okay. Keeping in mind, so what that means is that earnings, the P is the numerator in that equation, right? PE. The E is the denominator. So what that means is that earnings, measured as a percentage of gain, have not kept pace with the prices in the stock market. And the PE has been going up, overvalued. So that's one indicator, not a good sign going forward. The other reason has to do with the yield curve, this inverted yield curve that we've seen for roughly 2 years now. Yield curve. When people talk about the yield curve, you're watching the financial news, when they say the yield curve, they usually refer to the treasuries. So yield curve, I'm drawing this backwards for me so that it'll be right for you watching this video, but you have, this is y-axis, yield to maturity over here. Go take a line this way, the x-axis is time, or duration. Okay, so normally the yield curve, it goes like that. It goes up and to the right, meaning when when people buy treasuries along the longer duration, they get a higher yield to maturity. Right now, and for about the past 2 years, we still see an inverted yield curve, meaning people who buy treasuries shorter term, they're getting a higher yield to maturity than the longer term durations. Okay, so that's called an inverted yield curve. The explanation of why the yield curve is shaped that way, there's different theories to explain the shape of the yield curve. I adhere to what's called the market segmentation theory because it always made sense to me. The market segmentation theories to explain the shape of the yield curve goes like this. For each duration, there's a supply and a demand for that treasury. Okay, and that's what determines the yield to maturity. So you have, here's a supply and demand, 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 so on and so forth. And all those supply and demands for each duration creates the shape of the curve. So money flows where it's treated best. But if we really wanted to make that even more accurate, what we would say is each individual has an opinion about the future, okay? And then, so the sum of all those individual investors' opinions creates an aggregate opinion about where money is going to be treated best. So, the treasuries are not the stock market. The stock market is the stock market, right? Treasuries are treasuries. Where else could people put their money into other than treasuries? Well, they could put it in the stock market. But when you see an inverted yield curve, that what that aggregate opinion is saying is, we're not real comfortable with where the stock market is going, so we don't demand supply, demand, supply, demand, supply, demand, market segmentation theory. We don't demand as high of a yield to maturity for the longer term duration as the shorter. In other words, they're saying, we don't, the yield curve is not steeply inverted, but it is inverted. It's just not a good sign. So what does that mean to you? if you're like a lot of people, you have maybe 2 or more accounts, 2 or maybe 3 accounts. You may have a regular trading account. By that I mean, in other words, not a retirement account, a regular trading account, not a 401k or a Roth IRA, for example. You may have a regular trading account, and then you have maybe a 401k where you have a required minimum distribution if you're like me. And, you know, at some point you're required to start withdrawing that, right? As opposed to a Roth IRA where you never have an RMD. But in any event, so a 401k, a traditional 401k, you have an RMD, a required minimum distribution. Well, when I talk about investing, I often, and I talked about this in lesson 3 of my series, Everything to Know About Investing. And I was, in that lesson 3, I was explaining the way I think about investing. I don't try to predict, you know, which way the market is going. This is not everything that I'm saying about the warning signs is not a prediction. I just buy more dividends. Market's up, buy more shares. Market's down, buy more shares. In other words, just keep the income going up all the time, regardless of which way the market goes. However, you can't really adhere to that strategy completely when you're looking at a 401k where you may have an RMD, because you're going to be required to, you're going to have to sell something to make that required minimum distribution, right? So you have, it's just something to consider, and, you know, depending on your own specific circumstances, for a lot of people, they may be depending on that RMD to live on well into the future. And if that's the case, you may want to consider reducing risk. But then there's, you know, the bad news, and the other bad news is, well, how are you going to reduce risk? Yeah, you can move towards low beta, or you can move towards more fixed income and the like. But then the other bad news is, well, the interest rates in the long term is not as good as the short term. It's an inverted yield curve. You can buy short-term durations, treasuries or other fixed income, corporate bonds, etc. But it appears that interest rates may be on the way down again finally. Next month they're expecting an interest rate cut, may be as much as half a point, 50 basis points. So you may not be able to get as good an interest rate. You could buy a short-term duration, but then when that rolls over, you may not get as good an even worse interest rate, or not as good an interest rate when that rolls over. Okay, but it's just something to consider. If you don't want to completely get out of the stock market, and I'm talking about, for example, a 401k here, but you know, you have that RMD to concern yourself with every year, and you'd like to be, you know, you'd certainly like it to be more rather than less. Another choice could be to reduce risk by moving towards low beta. By that I mean, you know, if you don't want to completely get out of the stock market, maybe move more towards consumer staples, utilities, something like that. It's just something to consider. You can't risk what you can't afford to risk, or you shouldn't risk what you can't afford to risk. So in any event, it's not a prediction like about a market correction exactly. I'm just saying there's a couple of warning signs there. As Yogi Berra said, accurate predictions are difficult to make, especially ones about the future. But it's just something to be aware of. The 2 reasons that we could have a market correction at some point in the future, maybe a severe one, perhaps, because one reason, overvaluation. Earnings did not keep up with the prices as the stock market, and the other reason being the inverted yield curve. So, I'm sure everybody just loves me for coming up with that video, but you know, you can't help people by lying to them. You need to tell them the truth, or at least the truth as best as I see it anyway. So in any event, that's just some things to take into consideration. We could be headed for a market correction for those 2 reasons. Okay, until next time, hope y'all, this is Saturday, August the 10th, 2024. I hope everybody's having a great weekend, and good luck, America.